This show is produced by the Hartman Media Company. For more information and links to all our great podcasts, visit hartmanmedia.com.
You've got the best podcast going, Jason. I love your show, man. It's good stuff.
Oh, thank you. I really appreciate it.
What I wanted to share was my wife and I, for the first time ever, paid effectively no income tax in 2022 through doing a cost segregation study and generating about a $200,000 paper loss on our real estate. I'm a real estate professional, and it really works. It's magic.
Welcome to the Creating Wealth Show with Jason Hartman. You're about to learn a new slant on investing, some exciting techniques, and fresh new approaches to the world's most historically proven asset class that will enable you to create more wealth and freedom than you ever thought possible. Jason is a genuine self-made multimillionaire who's actually been there and done it. He's a successful investor, lender, developer, and entrepreneur who's owned properties in 11 states, had hundreds of tenants, and been involved in thousands of real estate transactions. This program will help you follow in Jason's footsteps on the road to your financial independence day. You really can do it. And now, here's your host, Jason Hartman, with the complete solution for real estate investors.
It is my pleasure to welcome Rahul Sen Sharma, and he is an expert on indexes. His company is INDXX, spelled with two X's, and they are a global provider that tracks the shifts through 130 products tied to over $20 billion in index-based assets. When companies want to create an index or create an ETF or a fund, they come to his company to create that index and track that index. So you're going to get some really interesting insights today on the economy, on the trade war, on tariffs, and on the stock market as well. So, Rahul, welcome. How are you?
I'm good. Thanks for having me, Jason.
It's good to have you. You're coming to us from Miami, right?
Correct. Yep. Yeah, he's beautiful Miami in the background.
Excellent. Well, I don't know exactly where to start. We talked a little bit before the show, but obviously the thing in the news nowadays is international trade and tariffs. So maybe we want to start there. Give us your broad thoughts, if you would, then we'll drill down.
Yeah, I think that's a very good topic to start with, because as an index provider, we don't focus on the day-to-day. We focus on big picture exposures and big picture trends that are happening globally. So for example, we might build an index that's focused on a particular country or a particular sector, or when we start drilling down and getting more thematic, we might focus on something that is changing and disruptive, but in the longer term. Like, for example, artificial intelligence or unique rare earth and critical metals. So I think the timing of this discussion is very good, because at a time like this, most people kind of get very hyper-focused on what's happening on an hourly or daily basis, and they don't see the forest for the trees, so to speak.
Yeah.
So
I couldn't agree more, by the way, just generally and conceptually, I talk about the macro side of things, and that's what people need to focus on. There's this, it's almost like gambling. People are just really interested in, oh my gosh, this is happening, that's happening today. Zoom out, okay, and look at the big picture. That's just far more important, unless you are investing with your lunch money, right? Correct. Which hopefully nobody's doing that, right? They're investing for the long term, and that's really where the focus needs to be.
That's exactly it, because when you say the word gambling, I mean, it is really on a day-to-day basis, kind of like gambling. I was just in Las Vegas, and I always tell people who are out there, all this that you see in Vegas wasn't built because you won. It was built because you lost. And when you try and get into that gambling mindset, people typically, in any sphere of their lives, when they try and gamble, they typically lose more than they win. So, we're talking about tariffs, and of course we can talk about who we think from a big picture perspective might be winners and losers, countries like India. But I think what's important to look at big picture is what is happening here. I mean, these tariffs are really kind of a outgrowth of what we look at as an index provider and call re-globalization, almost like a globalization 2.0. For many decades, starting with Bretton Woods, we lived in the United States and we kind of benefited from the first phase of globalization, the cheaper goods, the access to global markets that have helped a lot of American companies become dominant. But what we've seen over the last 10 years, and especially over the last 5 years, is that globalization here in the United States and in other countries does have some downsides. You look at the supply chain issues that happened during COVID. When you have this just-in-time inventory focus and production focus when you're looking at goods coming from all over the world, it's not necessarily a good thing, especially when those goods aren't coming from countries that are necessarily friendly to the United States. So
Yeah.
what we
Well,
look at
tell us why that isn't a good thing, because I know there are people listening who are saying, well, I love these cheaper products at Walmart and Costco and on Amazon. Why isn't it a good thing? I mean, let's talk about American jobs and employment, right? That's huge.
Exactly. I mean, if you look at American just employment in terms of manufacturing from the 1970s until today, our population has grown significantly since that time period, but the number of manufacturing jobs has decreased by millions. So you have a economy that, yes, from a big picture perspective, from a market cap perspective, from a tech perspective, seems to be doing very, very well. But if you're somebody who doesn't have money that's invested in the markets, or if you're somebody who had a more manufacturing or blue collar related job, your standard of living has stagnated or reduced. And that's why politicians from both parties have really looked at trying to change globalization into something we call re-globalization. So, for a simple example of this is under the Biden administration, the CHIPS Act, trying to bring a critical industry like semiconductor manufacturing
Back to the
back to
US.
the United States. It doesn't really make sense when so much of our economy and our military and defense and critical industries are dependent on semiconductors to have so much of the production so close to China, for example, or an area like Taiwan, where China has been doing saber rattling over the last couple of years. So the CHIPS Act sought to and has been reasonably successful in bringing manufacturing thus far of semiconductors back to the United States, with Intel, with Taiwan Semiconductor investing over $100 billion in production in the US. So yes, on one side you get cheaper goods, but on the other side, there has been a hollowing out of manufacturing and a real movement of critical parts of the US economy from a defense perspective and from an overall big picture perspective away from the US into countries that aren't necessarily friendly towards us. So one of the things that multiple administrations have tried to do is to get away from offshoring and to move into what we call and what other people call nearshoring and friendshoring. So nearshoring is bringing production closer to the United States. So a big beneficiary of this has been Mexico. Canada has been another one, thanks to free trade and NAFTA, which started in 1993. The other thing that America has tried to do, and the European Union has tried this as well, is something called friendshoring. So it won't be bringing production back to the US, but it will be having the production with countries like, for example, India, that are open and amenable and friendly towards the US and Western values.
Yeah, very, very interesting. So, I can't help but think of Ross Perot when he ran for president and he had his cute little charts up there and he talked about that giant sucking sound.
Yeah.
He was right.
Yeah.
I mean, that's what happened to the high-paying American jobs. They went overseas. The big multinationals got to pay slave labor rates, or the companies over there got to pay very low rates. And the partners in a trade deal just aren't equally yoked. The playing field is very, very unlevel. I mean, if China wants to have an EPA and China wants to have OSHA and China wants to have, the same minimum wage we have, then you can trade in a fair way, right? But they're just not bound by the kind of regulations we have in the US.
That's absolutely true. It's not a level playing field when it comes to a lot of the core components and the base inputs of a lot of production related to manufacturing. And when you're talking about Ross Perot and his comments around the election, one of the critical moments around the discussions with NAFTA was when he appeared with Larry King and had a debate, really an in-person debate with Al Gore about NAFTA. And he, generally speaking, I think is regarded to have lost that debate, but he was right about a lot of these things. But he was also, looking at it from one perspective, which is manufacturing. If you look at it from a few other perspectives, America has definitely benefited tremendously from free trade. American companies are dominant on the global stage. Their market caps are dominant. The valuation of the American stock market is dominant, but he has been right in that a lot of those benefits haven't been equally distributed among the American population. And certainly when it comes to manufacturing and blue collar jobs and other critical industries, those have left because the US, as you said, simply isn't the most efficient place to produce or manufacture at this point.
Right. Yeah, it is. Okay. So where do we go from here? I mean, what can we expect in the coming year or so?
Well, short term, again, as an index provider, we don't look too much at the noise, so to speak.
Right. Yeah.
I think there are certainly going to
Which
be,
is great advice for all
yeah,
investors to not be distracted by the noise,
yeah,
right?
yeah.
Yeah.
I think there's certainly going to be periods of very high volatility. Probably, volatility this high doesn't stick around for long. We've seen that historically. It does tend to reduce. But if we look at just the tariffs, there are countries that are going to benefit and I think are very well positioned. And there are countries that are certainly going to have a much more rough ride. If you look at a country like India, I think India is quite well positioned here. Their tariff rate right now is around 26%, but there are certain sectors and industries, like, for example, pharmaceuticals, that are excluded from that. India has done a good job of being a kind of alternative to China when it comes to manufacturing as a friendshoring nation. There is a lot of discussion now around US companies moving more manufacturing away from countries that are affected negatively by tariffs like China and towards India, for example, increasing iPhone production. And India, for many decades, has done quite a good job of kind of being friendly with a lot of different countries and players. India is friendly with the US and Europe, but they are pretty friendly still with Russia and are getting a pretty good discount on oil, which is, of course, vital for a lot of manufacturing in terms of, cost of input. Another country like Mexico, thus far, does seem to have done a pretty good job at avoiding a lot of the more punitive tariffs. They are in discussions with the Trump administration. 80% of Mexico's exports go to the United States, and I think they are pretty well positioned from a geographic perspective in terms of nearshoring, as well as from a relationship perspective to really kind of come out of this hopefully better than other nations. China, I think, is going to have a rough go of it simply because they're the largest player in this whole discussion. Their tariffs are quite high, and they're certainly providing a lot of goods and services to the United States. But big picture, I think what we do see is a move towards these type of friendlier countries, these geographically closer countries. And I think we also are going to see a huge amount of movement towards US manufacturing as well, although that will take more time.
Yeah. So that US manufacturing means more high paying jobs for American workers. And that means more tax revenue for the IRS. And, we can't replace, and I know this isn't your area, but I just love to hear your speculation on it. We can't get rid of the IRS in favor of the ERS, the External Revenue Services, I like to call it, with tariffs. There's just not enough trade and not enough tariffability, if you will, to replace, $4 trillion in revenue. Not even close, right?
Well, again, we're not an expert when it comes to tax revenue, but I will tell you that yes, we have looked at it on a very high level basis, and the math doesn't add up. When you return to manufacturing and jobs, yes, eventually, if this continues, you will, of course, see more US manufacturing jobs. I think in the shorter term, you will see more investment in companies that are powering manufacturing infrastructure and development here in the US as well. So the companies that will help, with the shovels and the pickaxes and the nails,
right,
the screws and everything else, so to speak, that goes into building that infrastructure and that capability.
Yeah. So as far as indexes go, and this is a completely different type of question, but for the consumer, the investor, right, the investing public out there, when they look at these different indexes, say, for example, it's, we'll just take the biggest one, right, the S&P 500 index, and there's different providers of the same index. Are there any differences for investors? I mean, do they weight things differently? Are there different formulas by which they calculate your returns? And maybe that's not the best example because that's so standardized now. Maybe there's, like you said at the outside, an AI index, right? And one company's offering an AI index, but then another company is as well. Are there little tricks that these companies are playing with their indexes that maybe benefit or don't benefit the investors?
Well, there certainly are different rule books, that's for sure. I mean, even the S&P 500, which is owned by S&P Dow Jones, is run in a slightly different manner than a simple market cap top 500 index like our index 500 is, and you do have differences there. S&P 500 is not the top 500 companies by market cap. If you look at the top 500 market companies by market cap and you compare that to the S&P 500, historically the overlap has been anywhere from around 420 to 460 or 470 names. Now, of course, the largest names are all there, but there are a number of names historically that are not there and that the weights are different than a typical market cap weighted index. That's a very well-known index. If you get into the more targeted indexes, there are significant differences. I'll give you a good example. We have a cloud computing index with an ETF tracking it here in the US, and we have multiple ETFs overseas that track the same index. There are other cloud computing indices from other index providers. And when we've looked at the differences between the two, you have divergences in performance in one calendar year of up to 20%.
Wow.
1,000 basis points. And that's because there are different ways to target a smaller industry like that. We do it based on revenue, but other companies and other index providers might do it based off of AI or NLP or other types of screens. So you end up with different companies with different weights that are rebalanced at different times. So you can have significant divergences in performance. So we always say it's important to look at the index rulebook and understand how it works. And that's why we and every other index provider that's out there posts our index rulebooks publicly. Any index provider does it. And if you're any individual, you can go onto our website, download our methodology for any of our indexes, and see how we're developing the index.
Really, really interesting. Are the other rule books for the other indices, are they posted publicly?
Generally, they are. It's generally, depending on where the final product is listed, it's generally a regulatory requirement.
Okay.
So here in the US, if there is an ETF that's tracking an index, that index provider needs to provide a certain level of information publicly and freely available, including the index rulebook.
Really interesting. And you talked before we started today about self-indexing, and what would the alternative be? Outsourced indexing, or what would you call what you do?
So as an index provider, we're an independent third party.
Right.
There are, in certain countries, the US is one of them, there is the availability to self-index where a company can also not only have the fund, but also have the index as well. There still need to be walls in place, but it's largely referred to as self-indexing, where the same overall entity or parent company has both the fund and the index under one roof. That is not something that is very common in the US. There are some fund issuers that do that, but generally speaking, most like to have an independent third party like us running the index without a regard for the fund itself.
But in the US, self-indexing is legal and acceptable. And in some countries, it's not. So you can't do it at all, right?
Correct. Yeah. That is correct.
Interesting. And, there's been a decent amount of talk and writings in terms of the S&P 500 and, the popularity of index funds has just skyrocketed. And some out there are saying this is very dangerous because the Mag 7, for example, really just have too much weight in the index, and that's really who you're investing in. You're not really investing in the S&P 500. Kind of unpack this for us and tell us, is this really the concern some are making it out to be?
So this concern has generally come from active managers, and it's been around for 15 plus years. Because
the active managers don't like the indexes competing with them, right?
Correct. Because if you read, some seminal works like A Random Walk Down Wall Street, active managers generally after fees don't outperform the index.
Right.
I have a vested interest in saying that they don't outperform, but the data seems to show that to a certain extent as well.
Yeah.
As this share of ownership in US stocks and global stocks has increased through the ETF wrapper, through the passive wrapper, those calls have gotten louder. But what you have seen recently, and a lot of what you see during certain events like this, is you do see the share of smaller cap companies and others increasing when it comes to active managers. I think this is something you're going to hear for the next, 20, 30, 40 years, probably in perpetuity. But, it just is the reality. And from what I've seen from a data perspective, it just doesn't hold weight that the passive ownership is distorting the market.
Okay. So in other words, these concerns that some are saying are coming from the active manager community, right? Because they want to disparage the index community, right? It's interesting that there's this little fight going on there, and they're really not warranted, is what you're saying.
I don't know if disparage is the right term, but I think, when you have an industry that is seeing assets flow towards passive, I think it's a natural human emotion to question why that's happening and to say maybe that isn't the right course of action. But, the flows keep coming into passive, and it hasn't seemed to distort the market. That said, if you do have indexes where certain companies get too large, the index provider does have the right to alter the index methodology. What we saw last year was, for example, with the NASDAQ 100, there was an intra rebalance kind of change where they reduce the weights and change the weights and change the methodology as well. So that can happen as well. So yeah, once an index methodology is created, I think it's important to say it's not set in stone, especially if you're targeting a particular industry or sector. Change can happen, and you need to make sure the index keeps pace with the change and is targeting that theme, that sector, that area as accurately as possible.
Should the S&P 500 index be reworked? I mean, maybe we shouldn't have so much weight on just a few companies.
Well, we do offer alternate kind of large cap indexes ourselves. We are seeing a movement away from some of the bigger names and towards, for example, equal weighted versions or alternate weighted versions of large cap exposures. So I think the marketplace is the ultimate kind of leveler. And the marketplace will dictate whether or not those types of things pick up. But there certainly are alternate versions of those types of popular indexes that are out there and available.
Yeah, very interesting. What else do you want to share with people? I know we kind of jumped around as before we started the show today and talked about a lot of different things we could talk about. What else do you want people to know?
I would just say, as an index provider, there's a lot of really exciting things that are happening globally. And I think it's just returning back to what we started the conversation on. It's easy to get caught up in the day-to-day noise, but it's important to look at the big picture and what's happening from a transformative perspective. What's happening transformationally when it comes to electric vehicles, which are not really in vogue right now, but they are going to be transformative. What's happening when it comes to battery technology and battery production and manufacturing here in the US? What's happening when it comes to renewable energy in general? What's happening when it comes to nuclear, when it comes to critical metals, and changes from a global perspective that are happening with regard to reglobalization? So I think those are the things to focus on, and those are the things that will get people excited about what's happening in the markets from a big picture perspective. And that's what we look at as an index provider.
Interesting. And anything else you want to share before you go on what you're seeing there, what it means for the future of the economy and the world, because you do have your eye on these trends. Yeah.
We're seeing a huge amount of new companies come into these areas. When it comes to IPOs, when it comes to the investable universe, we see growth. We see growth across electric vehicles and manufacturing and in the entire ecosystem. We see growth across the entire global equity universe when it comes to critical metals and rare earth metals and the types of base materials that are going to be needed to power this global economy for the next 20 or 30 years. We also see a good amount of focus on countries like India, which are growing very rapidly, that have the demographic wind at their backs, so to speak. So I would say, look at those areas. We've been very fortunate in that, we're in a growing industry. We're a nimble kind of custom index provider that caters to our customers' needs, and we're able to kind of identify these types of trends before they enter the public consciousness. If you look at blockchain, blockchain kind of burst into public consciousness in 2018-19. We had built an index that targeted that in 2017. The metaverse, which not many people talk about today, is still developing and growing, but we built an index a year before Facebook changed its name to Meta. And it's the same thing now with globalization. We built a re-globalization index a year ago, and now people are looking at it. So there's a lot of exciting things that are happening that are not negative. There's a lot of exciting things that are happening when volatility is not as elevated as it is today, and it won't be this elevated going forward because simply it's not sustainable. Look at those things and understand where things are going. And that's what we do as an index provider as well.
Very interesting conversation. Rahul, give out your website. Tell people where they can find you.
It's www.indexx.com, and index is INDXX. So no E, two X's.
Oh, okay. Yeah. INDXX.com, right? Yeah. Okay, great. Thank you so much for joining us.
Of course. Pleasure. Thanks for your time.
Thank you so much for listening. Please be sure to subscribe so that you don't miss any episodes. Be sure to check out the show's specific website and our general website, hartmanmedia.com, for appropriate disclaimers and terms of service. Remember that guest opinions are their own, and if you require specific legal or tax advice or advice in any other specialized area, please consult an appropriate professional. And we also very much appreciate you reviewing the show. Please go to iTunes or Stitcher Radio or whatever platform you're using and write a review for the show. We would very much appreciate that. And be sure to make it official and subscribe so you do not miss any episodes. We look forward to seeing you on the next episode.